Today we are going to make a presentation about the financial ratio analysis for the company of Focus Dynamic Group Berhad. Without further ado, let's begin. First of all, for the background company, Focus Dynamic Group Berhad was incorporated in 2002 as a Focus Dynamic Technology Berhad. It was originally focused on engineering and industrial automation before it made a major shift in another direction. After that, it was renamed after Focus Dynamic Group Berhad in November 2015. This action is reflecting the company transition into the food beverages, entertainment, and lifestyle sector. It was also listed on the S market of Bursa Malaysia Security Berhad under stock code 0116, operating premium dining and entertainment concept, mostly located within the 5-star hotel in Kuala Lumpur. Okay, the next one is a liquidity ratio. Focus Dynamic Berhad.
Assalamualaikum.
Wait. Okay, for the liquidity ratio, Focus Dynamic Berhad take a sharp interest in 2020 when the current revenue rate reached 4.14 and the asset base revenue reached 3.45. This was driven primarily by the large cash inflow of more than 120 million ringgit from the new share and ICP issuance. The average collection period improved dramatically, falling from 148.9 days in 2019 to just 5.4 days in 2025. This confirming that the company shift toward a cash-based business model that collect payment almost immediately from the customer. Okay.
So this slide shows the company's capital structure ratios, which measure how the company finance its assets and its level of financial risk. From the debt ratio chart, you can see that the ratio increased from 0.41 in 2019 to 0.51 in 2025. This means that over half of the company's assets are now financed by debt, indicating a greater reliance on external borrowing and higher financial risk. Look at the time interest and ratio. It was positive in 2019 and peaked at 29.89 in 2020. However, it became negative in 2022, 2023, and 2025. This shows that the company's operating profits were not enough to cover its interest expenses during those years. Overall, these results suggest that the company is becoming more dependent on debt, while its ability to meet interest payments has weakened, which is a concern for both creditors and investors. Next. So this slide shows the asset management efficiency ratios for 2019 to 2025. Overall, total asset turnover fell sharply from 0.56 time in 2019 to 0.30 time in 2020, then gradually improved to 0.47 time by 2025. This suggests the company started using its asset more effectively again after the initial decline. For fixed asset turnover, the ratio increased from 1.99 time in 2019 to a peak of 4.01 time in 2020 before dropping and then rising again to 3.06 time in 2025. This means the company became better at generating revenue from fixed assets over time, especially in the later years.
Next, I will present about profitability and market value ratios, which is the curve shown here involve gross profit margin, operating profit margin, and also net profit margin. The key takeaways: gross profit margin rose steadily from 52.2% to 59.2%, reflecting the company's successful shift toward premium F&B concepts with stronger pricing power and more profitability product mix. Operating profit margin collapsed to minus 115.7% in FY 2022 due to substantial investment impairment losses before gradually recovering to minus 1.5% by 2025. Though this has yet to turn positive. Net profit margin stayed negative in 4 of the 5 periods, showing that otherwise strong gross margin were repeatedly ended by non-operating expenses and impairment charges. On market value, the share price fell from RM 0.035 to RM 0.010 over the period, and no dividends were declared in any of the 5 periods, reflecting with investor confidence.
So this slide is summarized the company financial strength and weakness based on the ratio analysis. So the first one is the strength. The company has shown strong revenue growth, with revenue increasing from RM 39.1 million in 2019 to RM 121.2 million in 2025. This means customer demand has grown significantly. Next, the gross profit margin improved from 52.2% to 59.2%, showing that the company is earning more profit from its sales and has stronger pricing power. The company also has highly efficient cash collection. The average collection period decreased from 148.9 days to only 5.4 days, meaning customers are paying much faster, which improves cash flow. Lastly, the fixed asset turnover increased from 1.99 times to 3.06 times, indicating that the company is using its asset more efficiently to generate sales. Now, the weakness. Despite higher revenue, the company experienced a persistent net loss in 4 out of the 5 years, with the worst net profit margin reaching negative 122.8% in 2022. The interest coverage ratio was negative in the last 3 years, which means the company operating income was not enough to cover its interest expenses. Another weakness is the declining liquidity. The current ratio dropped from 4.14 to only 0.67, which is below the safe level of 1.0, indicating possible short-term cash flow problems. Finally, the debt ratio increased from 0.41 to 0.51, showing that the company is becoming more dependent on debt financing.
So, this slide show recommendations and conclusion. Based on our analysis, we recommend that the company improve short-term liquidity, reduce operating costs, focus on profitable outlets, renegotiate financing terms, and diversify revenue sources through food, delivery, and catering services. In conclusion, Focus Dynamics has strong revenue growth and good gross margins. However, recurring losses, weak liquidity, and rising debt indicate significant financial risks. Therefore, management must improve profitability and liquidity to achieve sustainable growth in the future.